Hello traders, welcome to this introduction to candlestick analysis. Now this tutorial has been broken down into 5 elements where each element reveals a different aspect of market behavior and the predominant market sentiment. So even those amongst you who have had prior trading experience, don't dismiss this training and think I know it, as it contains a different approach that is not often discussed when what you would call a technical analysis. And being able, obviously, to analyze these 5 elements is a prerequisite for successful price action trading. The 5 elements are these. Number 1, the strength ratio. Number 2, the size of the candlestick body. Number 3, the length of the candlestick shadows. Number 4, the body to shadow ratio. And finally, the position of the body. So once again, don't discard this because you think, I know about candlesticks. I think you'll find this very helpful, and it never ever hurts anyway to go back and retrain some of the fundamentals, and I'm sure you'll find some of the aspects of this training are very beneficial to you. So having said that, let's rip in and let's discuss element number 1, the strength ratio. Traders, to understand price and candlestick analysis, it helps if you think of the markets as a battle or a war between the buyers and the sellers. When the buyers speculate that price will increase, obviously it increases buying pressure, and this drives prices higher through the sheer volume of buy orders in the market. Sellers, however, bet on prices falling and push prices down with increased selling pressure through their volume of sell orders in the market. If one side is stronger than the other, then the following trends emerge. If there is more buying pressure than selling pressure, or more buying interest than selling interest, it simply means the buyers do not have anyone left that they can buy from. The price then becomes so high that the sellers once again find it attractive to enter the market. Now, this is called selling on strength. At the same time, the price is also too high for any more buyers to keep buying, because obviously buyers want to buy when price is low and sell when price is high. This is called buying at value. If the price is already high, buyers no longer enter the market because they are buying at higher prices. That price no longer makes it attractive to enter the market. However, if there is more selling pressure or more sellers than buyers, the price will fall until a balance is restored in the market. And once again, the buyers find it attractive to re-enter the market. The greater the imbalance between these two forces, the faster the movement of the market in one direction or the other. However, if there is only a slight imbalance, then the price tends to change more slowly. The markets tend to move slower. At times, in fact, most of the time, the buying and selling pressure is in a state of equilibrium. In other words, no one side is more dominant than the other. Therefore, at this stage, there is no reason for price to significantly change. Both sides are at a standoff, if you like, and are satisfied with the current price, with neither side making a major move. Now, this is called market balance. Now, while this is very elementary, it's always important to keep this in mind, because any price analysis aims at comparing the strength ratio between the two sides in the market to evaluate which of the market players are the stronger, if any, and therefore in which direction does price have a higher probability of heading. It's also helpful to argue the case before you enter the market from both sides and ask yourself these questions. Number 1, who is winning? Number 2, who's losing? Number 3, what would have to happen to make the buyers or the sellers liquidate their positions? And number 4, what would have to happen to make the buyer or sellers commit more into the market, more buyers or sellers to enter the market? And number 5, what is most likely to happen? So if you evaluate the market from both sides and ask yourself those questions, you'll have a clearer view of the market sentiment. Having said that, let's now move on to element number 2. The size of the candlestick body shows the difference between the opening and the closing price. And it tells us a lot about the strength of the buyers or the sellers in the market. The most important characteristics when it comes to analyzing the candlestick body are these. Number 1, a long candlestick body that quickly leads to rising prices obviously indicates more buying interest and indicates a strong price move. Number 2, if the size of the candlestick body increases over a period as price continues to move, then the price trend accelerates and the trend of the market is intensified or becomes stronger. Number 3, when the size of the body begins to shrink, this can mean that the prevailing trend may be coming to an end, owing to the increased balance strength ratio between the buyers and the sellers. Number 4, candlestick bodies that remain constant or remain a similar size obviously indicates a stable trend, a period of consolidation. And number 5, if the market suddenly shifts from long rising candlestick bodies to long falling candlestick bodies, it often indicates a sudden change in trend and highlights strong market forces in the opposite direction. Let's have a quick look at element number 3. The length of the shadow or the wicks help determine the volatility. In other words, the entire range of price movement over a given period of time. Now, the most important characteristics of candlestick shadows or shadow analysis are these. Number 1, candlesticks that have long shadows or wicks can be a sign of uncertainty and often signal for the trader to be on alert because it can mean that the buyers and sellers are strongly competing, but neither side has the upper hand at this stage. So far, candlesticks with long shadows often confirm the continuation of a strong trend, or at the same time can often lead to a strong reverse in price direction. Number 2, short shadows or smaller wicks indicate a stable market with little instability. Once again, this often allows the astute trader to enter a stable, reliable market in the direction of the predominant trend. Number 3, we often see the length of the candlestick shadow increases after long trending periods. This indicates that the battle between the buyers and the sellers is intensifying and the strength ratio is no longer as one-sided as it used to be. Once again, the trader should be aware of this as a potential trading opportunity, as this often signals a change in trend direction or a reversal. Number 4, healthy trends which move quickly in one direction usually show candlesticks with very small shadows at either end of either side. It shows that one side is more dominant in the market than the other, and it indicates a healthy trend. Therefore, if you see that, the trader should be on alert for buying or selling opportunities when they enter the market as a continuation signal, perhaps. So they are trading with the current momentum of the market. So if you find the market is producing a series of candlesticks that have very short wicks or shadows, then that is a very good indication of the momentum of the market. And once again, the astute trader would simply look for a continuation signal, for example, provide you know what that is, and you have a degree of confidence or another confluent factor, if you like, on your side, knowing that you are entering the market given the underlying momentum, which is displayed by the length of the shadows or the wicks. In this case, very, very short shadows. Let's go on now to element number 4. Traders, let's discuss the important factors when it comes to the body to the shadow ratio. Number 1, during a strong trend, the candlestick bodies are often significantly longer than the shadows. The stronger the trend, the faster price pushes, obviously, in the direction of the trend. During a strong upward trend, for example, the candlestick close is near the candlestick high, and therefore they don't leave much of a candlestick shadow at all, or only have a very small shadow. Number 2, when a trend begins to slow down, the ratio changes and the shadows become longer in comparison to the candlestick body. So once again, if you see candlesticks with a smaller body and a longer wick form within a strong trending market, it should put you on notice that the mood or the sentiment of the market is becoming more indecisive, and you would be potentially looking to trade a reversal. Obviously, you wouldn't just enter because you see candlesticks with small bodies and long wicks. You need more confluent factors, obviously, or reasons to enter the market. But what it does tell you is to be on alert for a change in trend direction, or at the very least, a correctional move. Number 3, sideways movement or a market is usually characterized by candles that have very short bodies and long shadows. Ideally, the shadow is about 2/3 the size of the body. Now, once again, this means there is uncertainty about the future track of the market, and very often leads to a strong reverse in price direction. So here's a tip, guys. The longer the shadow or the wick in comparison to the body, the more likely price is looking to reverse. And the longer the shadow or the wick compared to the body, the more explosive that reversal is. So if you find a market that is trending and then you find the body to shadow ratio begins to change, where it started off in a strong, stable trending market where the body to shadow ratio was even, very small shadows, and then you begin to see a smaller body and longer shadows, either bullish or bearish, that puts you on notice that quite often that is a sign that, once again, that could be a change in trend direction, or you could be looking at a correctional move. And the longer the shadow, either a bullish or a bearish shadow, in other words, the longer the wick or the shadow above or below the body, the more, I guess, obvious, or the more opportunity, or the stronger, if you like, the opportunity of a trend reversal becomes. Obviously, you wait for that reversal, that correctional move to actually happen. But if, once again, if it's a longer wick or a longer shadow, then quite often you'll find that reversal move or a correctional move, which could lead to, in fact, a change of trend direction, can be quite explosive. So keep an eye out if you're in a trending market and you begin to see candles that have a short body and a long wick ratio, that can often lead to a change in trend direction, and you want to be put on notice to potentially look to trade that reverse potential opportunity, should in fact you get a price action buy or sell signal confirming that you should enter the market. Thanks, guys. Let's now have a look at our last element, element number 5, the position of the body. Traders, as far as the candlestick body is concerned, in most cases, we can distinguish between one of two scenarios. If you see a candlestick which has a very dominant shadow to one side and a very small body at the opposite end, then this is a rejection candlestick. It's known as a rejection candle, commonly known as a pin bar or a hammer. Now, whilst this isn't a lesson on pin bars, I have created a video tutorial titled The Power of the Pin Bar, so make sure you watch that. The long shadow and the small body indicates that although the buyers or the sellers tried to move price in one direction, the opposite of the market players, if you like, entered the market and strongly resisted this move and push prices in the opposite direction. This is an important, very important behavioral pattern which should not be ignored. Another very typical scenario, of course, shows a candlestick with two equally long or close to equally long shadows on both sides relative to the body. Now, this is an indecision candle, and once again, it's commonly referred to as a doji. On one hand, it shows uncertainty in the market where no one is in control at the time. But it also highlights the balance between the market players. The buyers have tried to push prices higher, whilst the sellers have tried to push prices lower. Consider this balance as a rest period, if you like, where the market is catching its breath. After this rest period, price often breaks the stalemate, with one side once again taking control, resulting more often than not in an aggressive move one way or the other after this indecisive candle has formed on your charts. So this indecision candle should be seen as an opportunity for you to wait and do nothing until you can clearly see, after that candle has formed, that either the buyers or the sellers have once again taken control before you decide to enter the market. Now, traders, this was a very short lesson, but that completes this tutorial on candlestick analysis. So as always, I hope you found this information somewhat helpful. It's, once again, to repeat myself, when I started this video, it was always helpful to go back to things that you already know. Now, some of you guys watching this won't know this, many of you will, but it never ever hurts to go back and to relearn some of the fundamentals, because as our knowledge increases, we actually tend to forget some of the basics. So that's why I created this video. It's designed to help those of you who are just starting out and trying to analyze what does a candlestick actually mean? What does it mean when I see a candlestick on the chart? And of course, it's also designed to help you guys who already trade and familiar with candlestick patterns to once again familiarize yourself with these 5 key elements. And of course, as I said at the start, they make the basis of a price action analysis. It starts with being able to determine what does a candlestick actually mean when I see it on my chart. So once again, guys, I hope you found this little video tutorial helpful. Go and watch that video that I did on the power of the pin bar. It has a very, very strong signal. It's my favorite signal to trade. Obviously, I don't trade just because I see a pin bar form, but make sure you go and watch that video tutorial about the power of the pin bar, and I would encourage you to become an expert on trading the pin bar or the hammer if you're not already. Anyway, guys, until the next tutorial, talk to you soon. Happy trading. Bye for now.